Did you know that nearly 90% of investors, yes, even the so-called experts, fail to beat the market over the long term? Shocking, right? Most people think investing is all about picking the right stocks at the right time. But in reality, it's about avoiding the mistakes that can cost you big. And here's the truth. Even the best investors, like Warren Buffett, make mistakes. So, what separates the successful investors from the ones who get burned? It's the ability to spot and avoid common investing traps. From falling for hot tips to holding on to losing stocks, these mistakes happen more often than you think. In this video, we'll uncover the strategies to avoid these pitfalls. In the next chapters, we'll dive into what you need to stop doing to improve your chances of success. We'll look at why following trends can cost you, how overconfidence leads to failure, and why sometimes patience isn't always a virtue. Stick around, because by the end of this video, you'll know exactly how to avoid the biggest mistakes that even experts make. Let's dive in. Chapter 1. The Illusion of Hot Tips. Why following trends could burn you in the world of investing. It's tempting to follow the latest hot tips, especially when everyone around you seems to be making money. But chasing trends often leads to disaster. One of the most common mistakes investors make is jumping into stocks because they're hot at the moment. We've all heard the stories. A stock surges by 20% in a week, and everyone starts talking about it. The truth is, most of the time, these surges are temporary. According to a study by the CFA Institute, 90% of active fund managers underperform the market over the long term. That's right, experts don't always get it right. Warren Buffett often says, "Be fearful when others are greedy and greedy when others are fearful." This quote reminds us that following the crowd rarely leads to good results. In fact, jumping on the bandwagon of a stock that's already gone up can be a recipe for losing money. Why? Because by the time the trend is obvious, the best opportunities have already passed. Value investing focuses on finding undervalued companies that others overlook, companies with solid fundamentals, not just buzz around them. A real-life example of this mistake happened during the dot-com bubble of the late 90s. Investors rushed to buy stocks like Pets.com, thinking they could make quick profits. However, those stocks crashed shortly after, and many investors lost everything. This illustrates the danger of buying based on excitement rather than solid analysis. If you follow trends, you'll likely end up buying high and selling low. The key to avoiding this mistake is to focus on the fundamentals. Ask yourself, is this company undervalued? Does it have a strong business model? What's its growth potential? By sticking to these core questions, you'll avoid falling for the shiny distractions of hot tips and trends. Chapter 2. The overconfident curse. When your gut feels right, but it's wrong, it's easy to believe that because you've had a few good investments, you're now a market expert. But overconfidence is one of the biggest traps even experienced investors fall into. Research by the National Bureau of Economic Research found that overconfident investors tend to make riskier choices and trade more frequently. This behavior leads to worse returns over time. It's simple. Overconfidence blinds you to the risks that others might see. When you trust your gut too much, you ignore important data. Value investing, however, is grounded in data and analysis, not feelings. Buffett himself warns against overestimating your ability to predict short-term market movements. Instead, value investing teaches patience and discipline. It's about buying companies that have strong fundamentals and holding them for the long haul. There's also a psychological element at play. The illusion of control is when investors believe they can influence outcomes, even when they can't. This happens when you think your success is due to your skill, rather than luck. A classic example is the story of Bill Miller, a fund manager who outperformed the S&P 500 for 15 years. His overconfidence led him to hold on to underperforming stocks, and eventually, he experienced a significant downfall. Avoiding overconfidence means being humble and honest about what you know, and what you don't. Keep a checklist of key metrics for analyzing stocks. This could include price-to-earnings ratios, dividend yields, and debt levels. Having a set process helps you make decisions based on logic rather than gut feeling. Remember, the best investors are the ones who keep learning and never stop questioning their assumptions. Chapter 3. The Price of Patience. The hidden dangers of holding too long. Patience is often hailed as a virtue in investing. But there's a difference between being patient and being stubborn. While value investors are typically long-term thinkers, holding onto a bad investment for too long is a common mistake. Buffett himself once said, "The stock market is a device for transferring money from the impatient to the patient." But this doesn't mean holding a losing stock just because you bought it. Holding on to underperforming investments can prevent you from making better choices. A study by Fidelity Investments found that the best performing investors were those who had long periods of inactivity. They let their investments grow, rather than constantly shifting from one stock to another. However, this doesn't mean sticking with every stock forever. There are times when the fundamentals change, and it's smarter to move on. Take the case of Kodak, a company that was once a giant in the photography industry. Investors held onto Kodak stock long after its business model became obsolete. The company's failure to adapt to digital technology led to its eventual collapse. This illustrates the danger of holding too long, even when the writing is on the wall. The key to avoiding this mistake is regular evaluation. Just because you bought a stock at a low price doesn't mean you should hold onto it indefinitely. Reassess the company's financial health every few months. Look at its earnings growth, industry position, and how well it adapts to changes in the market. By doing this, you'll be able to spot when it's time to cut losses and move on, rather than being trapped by nostalgia or sentiment. Many investors don't realize that the real money isn't made by picking the next hot stock but by knowing when to sell. Selling a stock that's no longer performing well frees up capital for better opportunities. It's about being flexible and willing to make tough decisions when the time comes. Just because you bought it doesn't mean you have to keep it forever. Smart investing requires constant reassessment and the ability to pivot when necessary. By sticking to a strategy of regular evaluation and being willing to let go of underperforming stocks, you ensure that your portfolio stays aligned with your long-term goals. Patience doesn't mean holding on to everything. It means knowing when to let go and make room for more promising opportunities. Subscribe now. If you're enjoying these strategies and tips, don't forget to hit that subscribe button. Get the latest insights on smart investing and avoid costly mistakes. Let's keep learning together. Chapter 4. FOMO. Fear of missing out. The silent killer of value investing. FOMO, fear of missing out, is a powerful force that can derail even the most disciplined investors. It's easy to get caught up in the excitement of a stock that's skyrocketing, especially when everyone around you is talking about it. But acting on FOMO is a dangerous game. Research from the Journal of Financial Planning found that emotional decision-making often leads investors to buy high and sell low, the opposite of what a value investor should do. The truth is, by the time a stock is trending, the best returns have already been made. Warren Buffett once said, "The stock market is designed to transfer money from the active to the patient." FOMO plays right into the hands of the impatient. When everyone is buying into a stock because it's trending, it's hard not to feel left out. But value investing is about avoiding this pressure. It's about sticking to your strategy, focusing on undervalued companies, and not jumping into a stock just because it's hot. In fact, a study from the University of California found that FOMO-driven investors underperform by about 5% per year. That's a huge difference over time. Instead of following the crowd, value investors should focus on companies that are solid, profitable, and misunderstood by the market. One way to do this is by screening stocks based on criteria like low price-to-earnings ratios or strong dividends. Investors who let FOMO drive their decisions often end up buying into bubbles. One famous example is the 2008 housing crisis. People rushed to buy real estate, convinced they would miss out on big profits. The result? A massive crash. To avoid falling for FOMO, create a list of criteria for buying stocks and stick to it. Set limits for when you'll enter or exit a stock, and don't let emotions take over. Another way to combat FOMO is to remember that market trends don't last forever. Even stocks that look like they're rising fast can reverse course just as quickly. Take the rise of Tesla in recent years, for example. While its growth has been impressive, many value investors have stayed away because the stock price was far higher than its earnings justified. FOMO can trick you into thinking you're missing the boat, but patience is a more reliable strategy in the long run. The key takeaway here is to develop a strategy based on data, not trends. Let the FOMO fade and trust in your analysis. Remember, the best investments are often the ones others aren't paying attention to. Chapter 5. The red flags you're ignoring. How to spot danger before it's too late in value investing. Recognizing red flags is a crucial skill. Companies that seem like a good deal on the surface often have hidden problems. One red flag that many investors miss is a company's debt load. High levels of debt can put a company at risk, especially if it faces a downturn or rising interest rates. According to a report from McKinsey & Company, global corporate debt reached $81 trillion in 2021, which is a huge risk for investors. Another red flag is when a company's earnings growth doesn't match its stock price. If a company's share price is rising without a corresponding increase in earnings, it might be overvalued. As Buffett says, price is what you pay, value is what you get. You can avoid this mistake by regularly comparing a company's price-to-earnings ratio to its industry average. If it's too high, it could signal that the stock is overpriced. Management issues are another key red flag. If the company's leadership changes frequently or seems to lack a clear vision, it's a warning sign. A study from Harvard Business Review found that companies with unstable leadership tend to underperform in the stock market. Even if the company has strong fundamentals, bad management can prevent it from reaching its full potential. One classic example of ignoring red flags is the case of Enron. Investors ignored signs of financial trouble, including questionable accounting practices and an overly complex business model. The result was one of the biggest corporate scandals in history. As a value investor, you must stay alert for these warning signs. Look at the company's financial statements, read up on the management team, and keep an eye on the industry. Another red flag is the constant use of financial engineering to boost short-term profits. Companies that rely too heavily on stock buybacks or aggressive accounting methods may be hiding problems. For example, General Electric faced criticism in the 2010s for using complex accounting tricks that masked its true financial health. These tactics may make the company look good in the short term but lead to long-term issues. The best way to avoid these red flags is through diligent research. Take the time to study a company's financials, read its annual reports, and listen to earnings calls. The more you understand about a company, the easier it will be to spot potential dangers before they become major problems. Chapter 6. The set and forget myth. Why you can't just buy and ignore forever. One of the biggest myths in investing is the idea that once you buy a stock, you can just set it and forget it. While value investing does focus on long-term gains, it doesn't mean you can ignore your portfolio once you've made the initial investment. In fact, many investors make the mistake of thinking that long-term investing means no ongoing effort. But as Buffett himself has said, the stock market is a device for transferring money from the impatient to the patient, not the lazy. A study by Vanguard found that investors who regularly rebalance their portfolios achieve better returns than those who don't. This proves that consistent monitoring and evaluation are essential to successful long-term investing. By rebalancing, you ensure that your portfolio stays aligned with your goals and risk tolerance, preventing any one investment from becoming too dominant. The key to successful value investing is to stay engaged. This means regularly reviewing your portfolio and making adjustments as needed. While it's important to hold on to solid investments, it's also critical to reassess their performance and the market conditions. Companies can change over time, and so can the economy. A good example of this comes from the tech sector. In the 1990s, companies like Microsoft and Intel were seen as the future. But if you had held onto these stocks without considering changes in the tech landscape, you might have missed out on the next big thing. Value investors who took the time to reassess their portfolios could have shifted their focus to emerging tech companies like Amazon and Google. Investors should also remember that industries evolve. The companies that were once the dominant players can sometimes lose their edge. This happened with Kodak in the 2000s when it failed to transition to digital photography. The moral of the story? Never get too comfortable with your investments. Continue to learn about the market, assess the health of your holdings, and adjust when necessary. Lastly, regular review allows you to spot opportunities for new investments. Value investing is about finding underpriced stocks, and those opportunities don't always stay the same. As the market changes, new undervalued companies emerge. By staying informed and proactive, you can continue to build a stronger, more profitable portfolio. Don't forget to subscribe. If you found these strategies helpful, make sure to hit that subscribe button for more tips on avoiding common investing mistakes. Keep up with the latest strategies for successful investing.